Hey everyone, I thought I'll move this video outside and do a recording here just to get a bit of a change of scenery from the office and the books. So because I'm outside, you might hear some dogs barking. Maybe I'll introduce you to my dogs as we go through the video, but let's see. So the point of this video is to go through the question, and I doubt we're going to get to answers, but we'll see, of the tutorial Jerome Bongo. So this is a TUT from last year. It was test number 2, if I remember right. And it is a big question, 60 marks. You're lucky in that it still says ignore VAT, so you don't have to be integrating yet. But I think this is a good example of the type of standard you can expect for any questions that you get. I'm also noticing there's YouTube comments at the bottom, so that's gone. But yes. Where we are with this question, as I said, big question. I want you to please do this blind, like a test, like an exam. So if you haven't done that yet, please go back and do it now. A full amount of time. And yeah, so let's see what's going on. We start off and we got a company called Bongo Drums. It's a sole proprietorship. So straight away we're thinking that means it's going to get certain types of allowances. It's going to get, my neighbors just started playing music. I don't know if you can hear it in the background. It's going to get certain types of allowances. It's not going to be taxed as a company, though. It's going to be taxed in his own individual capacity. And we're going to add the income from his business to his personal income and then work out taxes per the tables. So sole proprietorships are a great way for me to incorporate you doing stuff like allowances, you doing things like trading stock and sales, with also doing stuff like rebates and things like that. Now, he's 52 years old, has 4 children, is unmarried. His wife passed away 10 years ago, and the factory that he has is a process of manufacture as regarded by SARS. He's never really understood financial accounting, got no knowledge of tax. Because of this, he's asked you to complete the tax return. Okay, pretty straightforward there. You're given the statement of profit or loss and other comprehensive income. Some numbers are missing, some are there. The key thing when you look at these is just to remember the notes, and also to try and remember if there are any sections that don't have a note attached to them and what you need to do with them. You're then given the notes from note 1 all the way down to notes number 5, and you're then given 2 additional notes. After that, you're given stuff in his personal capacity. So let's look at each of these in a little bit of detail. These notes talk about stuff that is happening in the business. What we've got, you've seen these before, it's a cash recon, reconning from cash to sales. The key thing that you have to remember here is that for tax, things are going to be recorded at the earlier of receipt or accrual, whereas accounting, they're only going to be looking at accrual. So you're just going to have to fix anything between the two. You're then given information regarding costs of sales. What you've got opening stock with 3,000 drums. You're given their cost, you're given their market value, and you're given the selling price of 100 damaged drums. The key thing to remember here, this is opening stock. Is that going to be a deduction, or is it going to be an addition to taxable income? And do you have to write them down because they have to be at the lower of cost or market value? Okay. Then you're told during the year we manufactured drums, okay, 10 of them were manufactured at a cost of 100, market value 260, and they were given to staff. So here you're starting to think about 22H recoupments. You're starting to think about should those be at market value or should those be at cost. And yeah, that's what you're basically thinking about. You're also thinking about the 22H proviso, which may allow a deduction later on. I'm having to speak louder because my neighbors have turned up their music again. So I'm hoping this is going to work. Bongo Drums also has closing stock. So you're going to have to work out what's going to happen with your 22 closing stock. Again, think about whether this is added or deducted. Again, you're told that there's more drums. Okay, you're told that last year's ones were all sold. However, at the end of this year, there are more drums that are damaged. You're given market value. In this case, you're not given cost of those drums, but you are given how many drums were sold in the period, what total manufacturing costs were. You've got opening stock numbers, you've got closing stock numbers, so you can work out the cost per drum of those manufactured in the year. Okay, a little bit of integration with MANAC here. 3. Included employees' costs is an amount of $96,000 you paid to one of your factory workers. Paying factory workers, that makes sense. It should be employees' costs. Remember, you're always going to deduct the gross, not the net. Not that that's what we're dealing with here, but just remember. On weekends, this employee works in Jerome's garden at his primary residence, and during the school holidays, drives Jerome's kids to and from activities. The employee's full salary is R8,000 per month, and is paid entirely through the business. 7,000 of this relates to work in the factory, and the rest relates to working in the garden and driving the children. So we've got an issue here in that we're paying somebody 96,000 a year, 8,000 Rand a month, of which 7,000 relates to work in the factory and 1,000 relates to working in the garden or looking after kids. So you need to start to think about, are both elements of this salary going to be deductible or not? Okay. Next, we are told that there was an amount that was spent to fix one of the manufacturing machines used to cover the drums. The machine needed a new blade as the old one was not sharp enough. We searched and were able to find the exact blade which the machine came with, and it cost 40,000 Rand, but we were also able to find a better one that cost only 43. The new blade was sharper, expected to last longer, therefore we decided to spend 43 on the better blade. We fitted it on the 15th of November. Key things here, you should be starting to think about 11D requirements. You should automatically be thinking, well, the new blade is better, so it's an improvement. But you should also be thinking about, well, how do we treat it if it is an improvement? It's not going to be an 11D repair, but what would it be? And that's something you're going to have to think about. On to point 5. I think this is probably the most difficult part of the paper. You're told accounting depreciation is the same as tax allowances except for the following. I give you 4 assets. I give you, well, let's just go through them one by one. We have a used manufacturing machine bought for 150 in 1 September 2019, written off over 4 years for accounting. Its market value on the day of purchase was 140,000. So you need to think, how do we claim allowances on a manufacturing machine? Is it new or used? Okay. Do we care about the 4 years for accounting, and do we care about its market value? Well, you have to remember, what is this asset going to be? It's probably going to be a 12C. So does it make a difference? Is it on low of cost and market value? And is it going to be 40, 20, 20? Is it 20, 20, 20? Is this the first year that we're actually in? And all those kind of things, what you have to think about. You also have to think about, I tell you that accounting depreciation is the same as tax allowances except for the following, which means these 4 assets are not the only 4 assets we have. It means for every other asset, tax and accounting are the same. So what you actually have to do is use the number that you're given as your tax allowances and then adjust. So in this case, what you're going to have to do in each scenario is add back the accounting depreciation, which you can work out, and then take off the tax allowance for each of the 4. Okay, I hope that makes sense. You're then told you got 2 new computers from HR used for admin purposes, 4,000 Rand each, 3 years for accounting, but you know for tax under 4,000, or they're 4,000, so that's a low amount, so you're starting to think about the 7,000 limit, all in one go for tax, and you're starting to think what's happening for accounting purposes. Okay. Manufacturing building, you've got the cost, you've got market value, you've got the period for accounting, so it's the same process as before, except it's going to obviously be some kind of a 13-1 asset. You've got a second-hand motorbike, all right? It's used for deliveries. The things that are different here, it's probably going to be an 11E asset, so you need to find out over how many years. The other thing is it's also got a residual value for accounting, which you haven't seen before. So that's going to affect your calculation for the amount of accounting that you have to reverse back. We then move on and see that we rent a delivery vehicle. We pay 8,500 Rand per month. We had a 5-year lease starting 1 May 2014. So you need to think about, well, when does that lease end? The neighbors have ended the music, which is good. When does that lease end? So is it in the current year? How many months in the current year? And then at the end of the lease, we were allowed to continue to use the asset for no charge. So here we're starting to think about these lease recoupments that happen at the end of a lease. Remember, there's going to be three possibilities. Either the amount that you pay is reduced by your old premiums, or you buy it for no charge, or you get to use it for no payment or for limited payment. In the scenario, you have to think about, well, how do we work out what the recoupment is? And the fact that I give you when they purchased the car and the price that the other person purchased the car for is probably leading you to think you're going to have to do something with the reducing balance method. Okay. I do have a feeling, I'm just going to scroll up quickly, that these numbers 1 and 2 actually should have been 6 or 7, but for some reason it restarted the numbering. Okay. So 0.6, 0.7. In the 2019 year of assessment, Jerome had taken out a loan to purchase a piece of land as an investment, purchased it for $1.5 million. He sold 60% last year, and the remaining 40% he hasn't sold. Okay. In the 2020 year of assessment, the bank waived 50% of the capital balance of the loan. No interest accrues and no capital payments have yet been made. So we're looking at a scenario of debt forgiveness here, where something has happened and the debt has been forgiven. It happened in a previous year, so you're going to have to start to think about what happens when old debt is forgiven, but you've actually sold the asset for which that debt related to. Is there going to be some kind of a recoupment? Are you going to have to recalculate CGT? Things like that. We then move further down and you see that in his personal capacity, so this is linked to the business, but separate, so you can work out the taxable income from the business, then you're going to work out his own. He pays himself he does not pay himself a salary. I say what it would have been. So you have to think about whether this theoretical amount has any effect on the taxable income. You are told that he gets a foreign dividend from Nigeria. You're also told that he owns 4% of the company. Why is that important? Well, you need to start thinking about the exemptions. Local interest he receives. Key things, think about his age, think about the exemptions. Not a member of a medical aid, so you know that you're not going to have 6A. But one of his children is disabled and he incurred qualifying medical expenditure, so you know 6B is something you're going to have to think about. You always can get 6B regardless of if you're on a medical aid. Think about what changes if you have a disabled dependent. You're also told he gives money to a provident fund, so you're thinking of your section 11F deductions and the limits from those. I tell you that he donates money to an approved PBO, so you're thinking of your section 18A deduction and its limits. I then tell you that he gave ownership of his yacht. Okay, I give you distance or length of the yacht and its weight to his daughter. Okay, I give you the consideration, I give you market value, I give you cost. I also tell you he made no other donations other than the one to PBO. So this is tipping you off to a few things. Donations tax, it's tipping you off to CGT, adding donations tax to the base cost of an asset. You're disposing to a connected person. So there's a lot going on here. I really love this element of the question. You're also told about the sale and purchase of a primary residence, of which some of it was used as a home office. So start to think what happens if you use a portion of it for non-residential purposes. Note that was bought in 2000, so it's before 2001. So you're going to think of that for your pre-valuation date assets. You also added a pool, and you're given a calculated TABC. So again, this is quite complex, quite integrated, but stuff that you should be looking out for. Ignore VAT, which is great. 11E over 5 years, and then you look at the required. It's a 5-mark discussion on repairs. Okay, so the 96,000 Rand, but not just repairs. It asks just for the normal tax effects of what you did. It then asks for the tax effects of the new blade. So you've got 11 marks of discussion, followed by 48 marks of just calculating the normal tax payable. At the same time, start to think about the other questions I could have asked. Start to think about donations tax possibly. Start to think how this might have looked for if it had been if he had died. Start to think about estate duty. But yes, This is the stuff you should have been thinking about when you do the question. Okay.